The Fed has once again done it again, hiking interest rates for the 11th time in this cycle, taking the Fed funds rate to the highest level that we've seen in nearly 22 years. But here's the thing, it's not likely to actually affect interest rates in a negative way. And in today's video, I'm going to tell you why. So the Fed ended their brief pause in interest rate hikes by taking the Fed funds rate up to a range between 5.25% and 5.5% by a unanimous decision. And this is the 11th increase since March of 2022, when interest rates were sitting at 0%. But with that, not a lot changed in the Fed's statement. But shortly after, during the Fed's press conference, is when we started to see some changes in the mindset of the Fed, with the main one being that the FOMC believes that the Fed's current monetary policy is restrictive, more or less saying that they believe that what they are doing is starting to slow economic growth, which is essentially their primary goal, to try to get inflation down to that 2% target. He also said that if data suggests more rate hikes are needed, that is a judgment that they'll make. In addition to saying a September rate hike is possible, but at the same time, no raise is also possible. And that's more or less in line with interest rate traders out there in the market, because as you can see from this chart here, the meeting probabilities more or less show that the Fed is likely to stay at this level for the foreseeable future, which again is in line with Powell's comment saying that they need to hold rates high for some time. And the reason he's saying that is because he's also saying that core inflation is still pretty elevated, and that the Fed is going to make decisions meeting by meeting. So they're not setting the precedent that they're going to pause in September, but they're also not setting the precedent that they're going to hike either. And as we've discussed in other videos, the Fed has been very, very clear on their direction since they started hiking back in March of 2022. And that's largely why I believe interest rates aren't really going to change very much in the interim. And we're likely to be in this sideways cycle for the foreseeable future. Now, before we go any further, if you're watching this video going, Jeb, did you just wake up? What happened to your hair? Well, it's because I put something new in it today. I put this powder in it that was supposed to make it textured, and instead it didn't really do anything. It's not holding my hair, therefore my hair is all over the place. But with that said, if you find any value in my videos at all, if you support the cause here, do me a favor and hit that thumbs up. Also, feel free to subscribe to the channel to continue looking at this crazy hair, and also to stay updated on everything real estate related. So as I mentioned a moment ago, the Fed has been very, very clear on their intentions from the get-go. And because they have more or less followed through on everything they said they were going to do, the market hasn't really acted irrationally because it was expecting exactly what the Fed delivered. As you've probably heard me say in the past, the market doesn't like surprises. So when we have surprises in the market, if the Fed were to do something that we weren't anticipating, or we get huge surprises in inflation or the employment numbers, then we start to see interest rates bounce all over the place. We see volatility, and that's what creates chaos in the market. Now with that, we're still seeing somewhat strong economic data out there, right? Employment numbers are down some weeks, they're up some weeks, but we're not really seeing any huge surprises in either direction. And that's another thing that the Fed is watching, right? They're trying to slow the economy without pushing us into a full-fledged recession. And they still believe they can do that. They still believe there's a chance for a soft landing out there, because even though they've been super restrictive with interest rates and slowing down the economy, we're still seeing a very resilient job market. At the same time, we're seeing US consumer confidence jump to the highest level since July of 2021. But here's where things get a little bit weird. You know Robert Shiller, the guy who created the Case-Shiller Home Price Index? He's also the guy that called the 2008 housing bubble. Well, he thinks he knows how the housing market will exit its latest period of exuberance, and why he believes a 10-year rally in home prices might actually be coming to an end as the Fed ends its latest hiking cycle. See, Robert Shiller believes that a lot of demand was pulled forward during this time because people thought rates were going to continue to go higher during that period of time. So he believes that a lot of people jumped off the fence and started buying homes because they thought that rates were going to continue upward. And so in turn, he believes that as the Fed pauses or ends their hiking cycle, that people now know that rates in theory aren't going to continue up, and therefore there's not this huge demand to go out and buy houses. But quite frankly, I think he's wrong. And the reason I think he's wrong is because I do believe that we had demand pulled forward, but I believe the demand that was pulled forward was done so when we had a period of super low interest rates. Because you had millennials turning prime buying age at a time when interest rates were trending somewhere between 2.5% and 3.5%, you had a lot of people that probably wouldn't have purchased during that period of time. But because interest rates were so low, it made housing so much more affordable. Therefore, people that might have purchased a year or two later, well, they actually decided to buy then because in many areas of the country, their mortgage payment was less expensive than it cost to rent. And so, yes, you did have demand pulled forward, but it wasn't because people were scared about the Fed hiking interest rates. In fact, at the moment, demand is sitting near all-time lows. And that's because interest rates are still pushing close to 7%. And that's why we're seeing mortgage demand fall as rates stay high. So we have less buyer demand out there. But here's the kicker. We also have less inventory in the market. So when you have both supply dropping and demand dropping, they stabilize each other, which creates balance in the housing market. And that's why you saw home prices advance once again in May, with the FHFA price index going up 0.7% in May. At the same time, when the Case-Shiller is showing that home prices dropped 0.5% year over year. So year over year from May of 2022 to May of 2023, home prices dropped less than 1%. But we all know that has been short-lived. In fact, instead of focusing on the negative year over year, why don't we talk about what happened from May of 2020 to May of 2021? Well, we actually saw home prices go up 16.9% during that period of time. And then from May of 2021 to May of 2022, we saw another 19.99%, which is nearly 37% appreciation in a 2-year period of time. So the fact that we see home prices pull back less than 1% means absolutely nothing in the big picture. And I believe as the Fed ends their hiking cycle, what we're going to see is economic growth continue to slow. And at some point, the Fed is going to start to do some sort of quantitative easing. It might be 6 months from now, it might be 9 months from now, it might be a year from now. And they're going to do that by lowering the Fed funds rate. And that's likely to be at a time when inflation has gotten back closer to 2%, although the Fed believes it's going to take until 2025 to hit that number. We should still see inflation continue to moderate, along with more normal spreads between the 10-year yield and the 30-year fix, which means rates are going to be coming back down during the same period of time. Once the Fed starts their quantitative easing, you're likely to see interest rates move even further down, which poses additional risk for housing over the next couple of years because we have that lack of inventory. Lower rates are going to mean more buyer demand, more demand. Not enough supply means housing prices continue to move up. Now, here's the thing. I don't think we're going to see 16, 17, 19% like we did between 2020 and 2022, but I don't think we have a recipe for any crashes in prices. As you've heard me discuss in other videos, the biggest threat we have right now to the housing market is the lack of inventory. And it's because of what the Fed did during the pandemic. They brought interest rates down so low, it's more or less locked people into their houses. In fact, Fed Chair Powell addressed it in the latest press conference when answering questions about the housing market. Take a look and let me know what you think.
I think we've got a ways to go to get back to balance, really for the reasons that you talked about. With existing homes, there are many people who have low-rate mortgages, and whereas they might want to sell in a normal situation, they're not going to because they have so much value in their mortgage, which means that supply of existing homes is really, really tight, which is keeping prices up.
So until we see any meaningful supply, we're not going to see a break in housing. So with that, if you're planning on buying a house, just focus on the things that you can control. You can control your savings, you can control your budget, what you're comfortable with, what you're comfortable paying. What you can't control are interest rates and prices, trying to pick the top or the bottom in the market. Buy when it's the right time in your life. And don't buy with the expectation that interest rates are going to come down in 6 months or a year or 2 years from now. It might take longer. What if inflation goes back out of control and interest rates stay higher? You don't want to buy and be in a position where you can't continue to make that payment. At the same time, don't buy if you can't afford it now. If you can only afford it because you think interest rates are going to be lower in the future, then you shouldn't be purchasing a home. And I know that's really, really weird coming from a real estate agent, is somebody telling you not to buy a home. But the reality is, if you don't have a longer term time horizon, you don't have money in the bank, you're not comfortable with the payment, as things currently stand, then you shouldn't be buying a home now. Now, with that said, you're not sure if you can actually qualify for a home or where you stand in the process. I created a 90-second quiz, if you will. Answer a couple of different questions, and it'll tell you whether or not you're in a position to buy a home, whether or not it's the right time in your life, if you will, based on your financial situation to buy a home. Now, something to keep in mind, it is free. There's no obligation there. Just, go to the link in the description below. You can fill out your information, and it'll give you an idea of where you stand. Now, the last thing I want to say is I do believe interest rates are still in trouble. Mortgage rates are in trouble. And if you're wondering what I'm talking about, do me a favor and watch this video here.